Okay, good morning, everyone, and welcome to today's Tuesday Market Outlook webinar. My name is Prakash Vijayanath. I'm a senior analyst here at Options Play, and today I'm going to be giving you my thoughts and analysis on the broader market. So, just our usual disclaimer before we get started. The types of securities, forms, and research tools used in this video are for demonstration purposes only and should not be considered a recommendation by Options Play or a solicitation or an offer to buy or sell any securities. This video is not intended to be used for individual tax, legal, or investment planning advice. The agenda today, we'll be starting off with the major equity indices, highlighting some of those key levels. We've seen some pretty neutral price action despite Friday's kickoff to earnings season. The major banks initially moved a little bit higher and then did move lower towards the end of the day, like JP Morgan. And we expected that to have a bigger impact on the major indices. That didn't really happen. Instead, we got fairly neutral price action. So we'll see where price could potentially head to next. But ultimately, it is looking like we are waiting for a fundamental catalyst to dictate the short-term price direction. But from there, we'll be moving on to fixed income and commodities. We'll take a look at the sector rotational model, highlighting which sectors are outperforming and underperforming the broader market. We'll take a look at a few subsectors of interest that I have for you today, and we'll end today's webinar with some bullish and bearish market observations. So starting off here with the S&P 500, and looking at the SPY ETF. Price is forming what's looking like a bit of a double top here at around 480 all-time high territory. Again, this morning, set to open a little bit lower. Futures are pointing downward this morning ahead of the open. And ultimately, like I said earlier, we need that fundamental catalyst to dictate future price action. Earnings on Friday, with the big banks kicking off earnings season, was somewhat ambiguous. Got a few mixed results, but overall didn't have too much of an impact on the major indices. We are seeing momentum kind of heading lower here on the daily time frame with the 50-period CCI. But at the same time, price is still moving a little bit higher, still at that all-time high level. We may see some resistance at 480. It's certainly turning out that way, but downside will be limited unless we get, catastrophic earnings announcements or, of course, retail sales coming out tomorrow that could also have an impact in terms of how consumer spending has been during a time of elevated interest rates. So those will be the two key things that investors will be looking at: earnings season and retail sales. Retail sales will be an important one for tomorrow because the Fed is looking to potentially cut interest rates as early as March, and a high consumer spending number would be good news because it would indicate that we could be avoiding a recession, or achieve a soft landing despite having elevated interest rates. So investors will certainly be paying a lot of attention to that. But for the short term, look out for potential pullback towards that 470 to 468 level. Further support can be found at around 453. Okay, taking a look at the NASDAQ 100, financial earnings or the big bank earnings will have less of an impact for the Qs, given the fact that the NASDAQ 100 is not made up of any financial names, mostly technology names and high growth names. And you can see here the price is also, after breaking into all-time highs, it did immediately pull back, once again revisiting, but set to open a little bit lower this morning. So overall, S&P and the NASDAQ structure does still look quite bullish, maybe shifting to neutral in the short term. But when you look at the bigger picture, we are still in the underlying bullish bull market or bullish trend. And therefore, it's only a matter of time before we could potentially see that upside break above 410 and continuation higher. But also like the S&P 500, momentum is declining. So we could be in store for a longer period of consolidation or even a further pullback where 380 to 390 would act as that additional support level. So in the short term, things are looking quite, I would say, neutral, maybe even slightly bearish for the large caps. But longer term, it's still looking quite bullish. Again, very much dependent on interest rate cut trajectory over 2024. Small caps, looking at IWM, the Russell 2000, we did see a breakout above that 200 major resistance zone on the weekly time frame. It only lasted about a week and a half, and then we saw a breakdown below that level. Small caps now underperforming large caps despite this period of outperformance, significant outperformance. Price set to open a little bit lower this morning, heading towards the 188 level, which is a 38.2 fib level as well. So those are the key levels for the Russell 2000. Still underlying, there is a bullish trend, no doubt about that, but that outperformance has shifted to underperformance. We've had a very rapid decline in momentum. So you may want to wait for further pullback, and maybe wait until you see some outperformance relative to large caps before you look for bullish ideas here for small caps. Right, TLT, the Treasury Bond ETF. So we're kind of experiencing a retracement lower that's feeling like it's going on for quite some time. I mean, initially we had an impulse move towards the $100 resistance zone. Price did respect that resistance zone and has since pulled back. The next key level of support that I'm looking at is at 94. So there is still some more further room for a decline. But in an interest rate cutting environment, we do expect bonds to continue to rally. And right now, we're still not seeing that in the last couple of weeks. So we could be, again, in store for a steeper pullback, very much dependent on fundamentals, because that's going to impact when the market sees the Fed cutting interest rates, and that's obviously going to have a huge impact on how treasury bonds and any bonds, as well as including the TLT ETF, how the price action moves in the next few weeks. So earnings will have maybe less of an impact here, but keep an eye on retail sales, on any jobs numbers. We do have also some Fed speakers, in the limelight this week that could provide some clues as to what the Fed are thinking ahead of this March potential rate cut. Okay, moving on to the US dollar. So with bonds moving lower, meaning that yields have moved higher, the US dollar has also moved higher here. It has actually broken above the 103 level. So quite a big move, especially when, last week I was looking for potential decline here. Price is structurally making lower highs, lower lows, and we've had a bit of an invalidation there. The next resistance zone sits at 104. I would say the longer term, it's still looking quite bearish for the US dollar, given that the ECB is actually quite hawkish and probably going to keep interest rates elevated for a bit longer. And the Fed is not, obviously it's a lot more dovish, and therefore they're looking to cut interest rates. That is going to reduce demand for the US dollar in the maybe medium to longer term relative to the other currencies. But in the short term, the pop-up higher in yields has seen the dollar index break out of 103 and heading towards this 104 level. 99 to 100 still remains a major level of support. Okay, taking a look at gold. So with gold moving inversely to the US dollar, we have seen it, respect this resistance zone, especially after today's breakout. Price set to open a good bit lower this morning. Still below the 192, 193 area, but not exactly reversing its overall structure. Structure still remains quite bullish, very steep uptrend here. And it does look like price is getting continuously squeezed up towards this 193 level. Now, if the US dollar continues to decline, like it has been in the last few months, we could potentially see that breakout for gold. But for now, gold's still respecting that key resistance zone. The risk to reward actually does favor the downside from this major resistance zone. But at the same time, you don't want to be bearish too long. You're looking at ideas like credit spreads that can take advantage of the neutral price action that we're currently seeing in gold. This consolidation, kind of like a slow trek higher, but it does have a clear level of horizontal resistance that it is respecting. Okay, moving on to oil. So oil, I mean, there's nothing really much to add from last week. A lot of consolidation, but it's a lot of consolidation happening at this major support zone between 65 and 70. And the last time we saw that was last year between May or until July. We saw a lot of consolidation before an eventual breakout. Now it's looking like things are shaping up to be a mirror image of that. We've had the downtrend. We're seeing the same consolidation. And we need a fundamental catalyst to really dictate whether we get a breakout or potentially a continuation of this decline. And right now, there aren't really that many fundamental catalysts. Technically, I mean, momentum is improving, but it's improving because of the consolidation. So I wouldn't look too much into that. Moving on to sector rotation, we have 4 sectors in the improving and leading categories. We have 7 in the lagging and weakening categories. So in the leading category, healthcare, staples, communications, and utilities pretty much in the leading category as well. So we do have our 3 defensive sectors all actually performing quite well. There's definitely a bit of a movement towards risk aversion. So that's why we are seeing that little bit more rotation towards these defensive sectors. But what I find quite interesting is you look at the opposite side of the spectrum from defensive sectors, and then you're looking at, your more cyclical sectors like technology, very much a risk on type of sector. And the technology is actually starting to improve in terms of relative momentum against the broader market. You look at a lot of the big technology names, they still seem to be holding their own ground there. So even though we are seeing a rotation into defensive stocks, we're also still seeing the same rotation into technology. And that explains why the major indices like the Nasdaq, like the S&P, are still able to remain at elevated levels. And also in the lagging category, we have discretionary. Keep an eye on this sector for tomorrow's retail sales numbers. It could very well see a pop-up higher, especially because this retail sales figure is ahead of earnings season. It could very well, cause a reevaluation of how investors are looking at discretionary stocks heading into this earnings season. We have financials rotating slightly into that weakening category, real estate in the weakening category as well, and also materials and industrials in the lagging category, both showing very, plenty of weakness against the broader market in terms of relative strength and momentum. Okay, KRE, the regional banking ETF. This was a subsector that I was looking at last week because I wanted to keep an eye on how earnings were going to be going, especially on Friday. And it actually has gotten off to quite a bad start, hence why we've seen that move lower. There's potentially some support here at around that 49 level. So let's see if price does bounce up higher from here. We also have some more bank earnings this week. Goldman and Morgan Stanley set to report today. So that could also provide a rebound. In my opinion, the risk to reward in the short term does favor the upside because the underlying trend is bullish. We've broken above a previous resistance zone at 49, and it does look like price is coming back to retest it. So keep an eye on today's price action. It could still very well be a good bullish idea, but it didn't really start off that well. Friday was really the day that we were looking for to see a potential breakout or a bullish candle heading into that 54 resistance zone, and then from there, an additional breakout towards 60. So I'm waiting for the pullback, but longer term target is at $60 level for KRE. Okay, and one of our longer term ideas, the Jets Airline ETF. And we've seen here price has been quite bullish, especially after forming that double bottom, which is when we were initially interested in this ETF. Since then, running into resistance at 1950, respecting that level. Friday's price action quite bearish, as you can see, a big gap lower. Delta did announce earnings, I believe, and it does look like there's plenty of bearish momentum here to see price continue towards the next area of support, which is a 1715 level. But from there, that does provide a longer term buying opportunity as well. And like I said, for this ETF, this is a long-term idea, longer term buying opportunity, and you may even want to consider buying the shares outright as opposed to simply looking at a shorter term options trade ideas, because it is quite a cheap ETF to buy, trading below $20 a share. And the risk reward in the long term favors the upside after what has been a very strong decline since 2021, really since the pandemic. It hasn't quite recovered, but it is on its way to recovery. Right, so moving on to some of the ideas that we discussed last week, we have Oracle. This was a bullish idea on a legacy technology name, and I'm seeing signs of consolidation. So we have an impulse move, followed by a breakdown due to earnings, and price slowly starting to show signs of capitulation, and maybe even a potential breakout above this 106, 107 level. Certainly some good price action. And starting to show signs of very short-term outperformance relative to the market. Like I said, technology names are performing quite well. And once we do get a breakout from that level, there is a nice gap full opportunity back towards 1112 to 1115, 115. So good risk reward still. We were looking at this last week, and so far it is going quite well for us. So let's see how this plays out in the coming weeks. So moving on to Lowe's, part of the home builders subsector. Lowe's, again, very strong move to the upside towards just shy of 230. And then we saw a bit of a pullback back towards 210, which was that major resistance zone on the weekly time frame. Price actually showed some very good bullish price action at that level, which is why we went bullish on this last week. And so far, again, going quite well at 220. Set to open slightly lower this morning, but still early days in this trade. So looking for a continuation of this rally back towards 228 and potentially that 236 area once again. All right, and finally we have Rockwell. So Rockwell, this is a new idea, and it's a very similar chart setup, right? We have a key level at just above 300. Price breaking above that key level is a minor level, but breaking above that level, kind of consolidating, but again, showing signs of short-term capitulation. It may consolidate for a bit more, so I would probably look at a credit spread, a put credit spread, to take advantage of the neutral price action and theta decay. And from there, looking for a move to break above 310 and a continuation higher towards that 330 level. So this is a new idea. Let's see how it plays out. But the technicals do point to the upside. It still has a couple of weeks or a few more days until its earnings announcement. So it could very well be waiting for earnings and may consolidate up until that earnings announcement. But from there, it could be a good earnings play just before that announcement. So keep an eye out for Rockwell up until then. Okay, and with that, that is all I have for you today. Big thank you all for joining me today, and I hope you all have a great trading week. I will see you next week, Tuesday, for another market outlook. Goodbye, everyone.